Hey everyone, I'm really happy to be here at this stage with such an amazing speakers from projects that I suppose most of you at least know them because they have done so much in the DeFi space. So thank you all for being here. Before we dive into the heart of the conversation, I suppose, as I said, most of the people in the audience already know your work, know and have used your projects. But let's start with a simple exercise. It would be cool if you can briefly introduce yourself, but also tell a bit about your projects in a way that even people that are new in the space will be able to understand. So yeah, who can start?
Oh yeah, there we go. So I'm Michael from Euler. I started the project back in 2020 with my co-founder Doug. So what is Euler? It's a lending and borrowing protocol, and in really simple terms, what it allows people to do is to earn interest on their assets to make them productive. So lenders deposit assets into the protocol, and borrowers come and borrow from the protocol and pay an interest rate to the lenders. And there's all sorts of different types of lending and borrowing, all sorts of different types of credit markets, and Euler started back in 2021 with a certain opinionated model of what that should look like. And just this year, we reimagined the protocol to abstract a lot of the functionality and essentially make it more of a meta protocol that allows builders and other developers to come in and build on top of Euler their own types of credit markets. So you can build anything from simple lending and borrowing pairs to more monolithic RWA style lending protocols or stable coins, uncollateralized lending. There's all sorts of possibilities. So in the end, Euler V2 is like a developer toolkit or an infrastructure layer for credit markets.
Hi, I'm Amplice. I guess head of Telegram chats at Gearbox, kind of strategy biz dev really. Gearbox is, for someone new to the space, Gearbox is kind of like a margin account where you can access both simple and complex strategies with leverage. For those of you who know a bit more about DeFi and stuff, it's kind of like a leverage-enabled smart wallet. And then there's also a lending side where people who use the leverage have to get the money from somewhere. So there's lending pools on the other side.
Hi everyone, my name is Grayson. I'm a lead engineer at Zerion. So Zerion's mission is to make DeFi accessible to everyone, whether you're a first-time trader or you're an experienced trader. As of now, we have 3 major consumer products. First one, it's a DeFi aggregator and portfolio tracker, which allows users to manage assets across different chains. Second one, it's a non-custodial wallet provider, and also through a mobile browser-first interface, which allows users to make transactions inside the app with different dApps. And recently, we also launched a third product, which is a ZK-based L2 chain, which supports gasless transactions and which makes the entire DeFi game level up. And on the business side, we also have our API product, which allows users to query on-chain wallet data in a nice REST API manner. So this is like the entire product suite for Zerion.
Hey everyone, I'm Andrei. I'm the head of DeFi for LiFi. LiFi is a DEX bridge chain aggregator. So think of it as a railway system, cross-chain, cross-border, and within the same border. So to make a parallel, you could go, if you want to go from Sofia to Varna or from Sofia to London, we'll find you the best route, like Skyscanner for on-chain assets. If you want to go from Ethereum mainnet to Arbitrum, from one coin to the other, we'll find you the best path. On top of that, if you want to zap into certain pools or vaults or LP positions, we will not only find you the best path, but also facilitate the actual entry and zapping into the said smart contract. So any token on any chain to any token on any chain, any token on any chain to any kind of action on chain.
Okay, thank you all. These were really good, direct explanations of what your projects are doing. But let's dive deeper. It's been 4 years since the popular DeFi summer of 2020, and since then we've seen that the market cap in the space is around 10 times bigger. The TVL is around 50 times bigger. So we can say that in terms of numbers, the space is quite different. But throughout this time, we can see that as usually, most users are mostly interested in high yields, quite often also the meme coins. And yeah, what do you think about this? Would the space continue like this, or would it mature? Would we see a shift towards more sustainable, stable, native yields and lower yield opportunities that bring more security and longevity? Amplice, can you start with that?
Sure. So I think like it's the wrong framing. Like the problem isn't high yields, the problem is high risk, right? Like what everybody wants is high yields and low risk. Yeah. And what we have is high yields and high risk. I think in terms of like the better risk adjusted yields, I think those are coming. But I don't think the current level of kind of call it speculation or risk seeking behavior is going to go away. Like that's part and parcel of the industry. I think what we need is more options for lower risk stuff as well. But like if you look at TradFi, it's not like there's, you know, in TradFi you can also take loads of risk if you want to. There are like 0-day options. There's like, you know, you can buy junk bonds, for example. These are all like high risk, high yield opportunities. Those in DeFi will continue to exist. It's just like, how can we also have a separate offering for people who are a bit less risk seeking with ideally high yields and lower risk, or if not like medium yields, lower risk.
Thank you. Andrei, can you?
Yeah, sure. So remember like 5 years ago or 6 years ago when we didn't have any type of DeFi, what kickstarted DeFi? It was the lack of yield. So with yield started everything. And then we had those ginormous, you know, 1000% APR, which were not sustainable at all. So on a long enough time frame, the market will find an equilibrium. And right now we're seeing with RWAs, with T-bills on chain, that the yield is not only going down, but it's getting more and more sustainable because we can tap into the traditional yield, but also within DeFi, like leverage looping, like lending and borrowing, you can still have sustainable yields of like, I don't know, like 12 to 15% without any risk assumptions that you have to take as a user or as a founder of a protocol.
Just adding to that, I think generally the atmosphere is going to turn into a more sustainable one. But like slight adjustment is that sustainable doesn't mean that it has to be low yield, but the key point is like it has to be stable. So I think over the past 4 years, we learned a lot of mistakes from, you know, like Ponzi-nomics, and these kind of schemes are not going to like make a long run, and it's going to be like unsustainable. Maybe for a few months it's good for your APY, but it's not like for a few years. So we've been seeing trends like companies doing real yield products where they introduce like revenue share scheme, or like RWA, as Andrei mentioned, like having real world assets that are backing up. It's something that is gaining more tractions. And then like also for different kinds of like companies, they kind of improve their UI UX in general, which educate a lot of people about how to, you know, take risk. We're doing like a lot of advanced, like maybe transaction simulation to teach people how to, you know, trade with caution, this kind of thing. So I think industry, it's like transitioning that atmosphere.
Okay, yeah. So as an overview, we don't want lower yields. We want still high yields, but with that are like native, secure. Andrei, you mentioned about real-world assets. So tokenizing RWAs is also another growing trend. Do you think that RWAs further will be integrated within DeFi? And what place do they have in DeFi, because they're with quite different natures?
They already are integrated in DeFi for, I don't know, 2 or 3 years. You can see that, for example, in Maker, for many years that part of the yield is coming from RWAs. If just the narrative is or wasn't there to be put out and, you know, in a storytelling way like other projects are doing right now, which they're not reinventing the wheel, but because we have this, you know, unique talent in DeFi of coining new terms for things that existed for years and years in TradFi. And it's not per se bad, but with RWAs, we already had them on chain. Right now, you can just have better access in a more fashionable way, so to say. So you can get, T-bills, you can get access to whatever other bonds from different states on chain, which is good. It's, where DeFi is ever expanding. So besides the, Ponzinomics that we have within DeFi and meme coins, now this helps and facilitates getting more institutions on chain, which would seek those kind of safe yields.
I would say, I'd say with real world assets, what we're seeing in the emergence of is really on-chain finance rather than just like hardcore decentralized finance. There are, when it comes to real world assets, there are often customizations that protocols need to have built in that allow additional features that institutions require when trading these assets. But as Andrei was saying, they're already here. You can already use T-bills as collateral inside lending protocols to borrow non-yielding assets and do carry trades and other things that people have loved to do in traditional finance for a long time. But it's I think that the market's only going to keep growing because ultimately the rails of DeFi, the technology we've developed is just so much more efficient. The disintermediation lowers the costs. The composability is a massive advantage. You're not stuck in one sort of isolated corner of TradFi where you have to, get permissions and move. It's just so clunky and so slow to do anything in TradFi, and in DeFi, it's just so quick to move between very different products at very, very low cost. So I think those markets are just going to continue to grow. And overall, when we were talking about yields before, the yields in DeFi were also often very reflexive depending on what was happening with the price of Bitcoin effectively. As Bitcoin went up or ETH went up in value, the demand to collateralize those assets and borrow dollars rose, and that increased the yields on dollar-based deposits for things like USDC. But as soon as the markets calmed down a little bit, those yields essentially started falling again, and so we ended up having these really reflexive cycles. And over time, I think we're seeing an end to that. There's this like boom and bust sort of cycles are slowly tapering out, and that's because the yield from TradFi is now flowing on chain and making things more sustainable in the long run. So yeah, I think it's a big growth sector, and it won't be boom and bust like previous cycles. People always look for that kind of narrative, but I think it'll be slow, steady growth as more and more institutions decide to come on chain.
Hello. I think one of the important things to stress, just to reiterate what Michael said, composability is so important. I think RWAs are great as long as they kind of don't break one of the core things about DeFi, which is everything can work together as Lego pieces, right? Insofar as there are projects that are doing RWAs and keeping everything composable, not keeping it so that only whitelisted addresses can use this thing, I think I'm pretty bullish. Insofar as there are institutions that kind of want to come in and do things totally on their terms, everybody's KYC'd, everybody's whitelisted, I think, not that I don't want them to do that, but I'm not as bullish on those things.
I guess just finally add a point is that, so RWA is nothing new, we all agree that, but it's just I guess in these 2 years, we're seeing a lot of tractions that are going to retail and institutional users. I think mostly because of expansion of asset classes. So think about RWA, we first started with maybe treasury bills and stocks, and then now we have real estate, luxury goods, and whole different kind of asset types. So I think it's opening more doors for traditional TradFi users or retail users, which allows them to have utility beyond just maybe governance token speculations or just giving them more options to do that. And then at the end, just mass adoption all goes back to retail and then bigger players. So I guess these kind of trends, it's just a more progression that we've seen in these 2 years rather than it's a new trend.
Okay, thank you all for these perspectives on RWAs. So let's shift the focus a bit on layer 2s. As you know, this is another really interesting narrative. New L2s are popping up almost every week. I think that it was the previous week when we saw the Unichain by Uniswap. So how important do you think is the interoperability across chains for the DeFi's future? And also what are the risks of the fragmented ecosystem, and how can we manage those risks? Yeah, Andrei.
Yeah, I can start. I mean, for our business is great. The more, the better, because we can always aggregate a new chain and go on a new chain and facilitate the railway for the users. But there's this very famous post on Reddit by Vitalik in which he debates a cross-chain future versus a multi-chain future. And kind of the conclusion was that we can't have a cross-chain, like a unified cross-chain system ever, because the incentives are not well aligned. As long as the VCs will pump money in and you can raise more money for an L1 or an L2, EVM or non-EVM, you will get more and more dApp chains. And for all the Cosmos Maxes, like I'm so sorry for them because their thesis is now becoming true in the EVM landscape, and they tried to do this 3-4 years ago within Cosmos. Even though they have a bunch of messages sent across chains, still it wasn't really translated into either price for their tokens or for actual user base that would use their scaling solutions or Cosmos chains. So I don't think it's bad, but incentives for now are not well aligned, and I don't think we will ever have a true cross-chain unified ecosystem. It will be a multi-chain, and what Superchain is doing, Optimism Foundation is doing right now with the superchains is great, but still it's still fragmented liquidity, and every single scaling solution is trying to build their own ecosystem of chains within that ecosystem. And even though you can jump from one chain to the other in the same ecosystem, if you want to go from Arbitrum to Optimism or to Solana, you still need a bridge. So the liquidity is still very much fragmented, which for the user, I guess that in some way for the power user is great because they can always seek more yield and more opportunities, but that's not how we onboard the next billion users. Telegram has done a great job at that, of having first the users and then deploying their chain, not the other way around.
I guess I would firstly say, like, I think all the L2s that Gearbox has or will in the future deploy to are necessary infrastructure for Ethereum scaling, and all of the other L2s that we won't deploy to are all scams. But like, I think it's a real problem. Like with Gearbox, for example, ideally, the ideal UX, both from our perspective and from the user perspective, is like you deposit your money in one place, right? And then wherever like that money should be lent out to, it just goes there. And we don't yet have the technology to be able to do this. I don't know whether or not, given L2 infrastructure, whether or not it's even possible, right? Like there's like based rollups and all these things, but I think hopefully the UX, like if we're gonna live in this world where there's like 100 L2s, and we want DeFi to, well, DeFi and Ethereum at least, to continue being competitive with Solana and other chains, then this is just something that needs to be solved. And as a non-dev, I would say like, devs, please do something.
Yeah, my perspective on that, I sort of disagree that it's going to be a problem. Like, it looks like a problem right now because there's this you know, Cambrian explosion of like L2s popping off everywhere, and they're all getting funded by VCs and so on. But liquidity begets liquidity. If you don't differentiate yourself as an L2, the liquidity won't stay with you for very long. It will just leave, and it will aggregate to places where it's used more efficiently. So it's a problem that will be solved naturally by the free market. The free market will solve this very quickly and prune away all these L2s that just aren't needed. If your L2 doesn't do something unique, then it just won't survive, I don't think. And if liquidity fragments to a variety of different L2s in the future, maybe there's space for 10 or 20 or something, I don't think that's a real problem in itself. That's not fragmented liquidity as an issue. That's fragmented liquidity because it's servicing real user need, and that's a perfectly acceptable form of fragmented liquidity. If I'm aggregating, trying to sort of abstract all these differences away from all these chains, I don't think that's often like helpful. If I'm doing a swap, I probably just want the cheapest possible price I can get on that swap, and maybe I don't care where the swap is happening. But if I'm depositing assets as collateral, as a massive fund, you know, tens of millions or something, I want it to go to a place where it's the safest. And all these different L2s all come with very different properties in terms of their security features and so on. So they will differentiate, and I think they will all find their own use cases, and lots of them will just die in due course.
Yeah, so I would further separate the question into like general purpose L2 and also app chains L2. So I think for general purpose like Base or Arbitrum, like interoperability is important because at the end, it's about, for users' point of view, it's about capital efficiency and also a unified experience. So you don't want to spend like $30 for just like bridging from one chain to another. So like really having those innovations to optimize the routes and things like that, it's like, I guess from user, it's really important. And at the end, like users don't care about like which chain you're trading from. It's all like, the aim is to go chain agnostic. It doesn't mean like we have to unify to use only one chain, but it's just like how do we make sure that our product is built in a way that it's delivering a unified experience for users. And about app chains, I think, I don't see it as a fragmentation, but it's more like diversification. I think like at the end, so chains will innovate in a way that like for specific use cases, there's like a to-go chain to build on that. For example, like if you're building GameFi, maybe Immutable X is one of the options. If you're building like privacy, then there's like one chain for your use case on that. So I think like this kind of ecosystem, having like to-go chain to build on which use case is something I see as the biggest trend. And also like we're still in the evolution stage of these whole L2 phase. I think like having more L2s like boosting the kind of, not really competition, but collaboration between different players and just innovate more is something I would foresee.
Okay, and from your answers, I got really interested, and I think also it would be interesting for our audience, if you don't mind sharing, like as users yourself, currently, how many chains do you use? You can just basically say a rough number, or yeah, if you want, you can basically say these few chains that you're using.
I would say 3. So Ethereum mainnet, Base, Arbitrum, and then you occasionally experiment by going elsewhere, but I don't really have time to be moving chains very often, so not very many for me.
All right.
Clearly not an airdrop farmer over here. Like 10 maybe, 10 plus. Basically, yeah. I mean, you try to put a little bit on every, hoping for an airdrop, you know?
I guess 3 active chains for me, so I use Ethereum, Base, and also Polygon.
I didn't hear any Solana, guys. You're not doing this right.
I'm on Solana.
Yeah. I guess that the big ones like Ethereum mainnet, Solana, and the L2 scaling solutions. But for us at LiFi, like we're aggregating, we have to aggregate all of them. So it's like more than 20.
Okay, so we do have some degens from the speakers. Okay, so let's once again shift our focus to another really critical topic, security in the DeFi space. With DeFi exploits becoming more and more sophisticated, what is the way to like balance security but also innovation? Because as you know, in DeFi especially, if you have a project that you constantly update, you make changes on the code, this can lead to some vulnerabilities. But on the same time, if you have, for example, an immutable smart contracts, then it's set in stone, but you can't make any changes. And if, for example, the market conditions change, you just need to deploy from the start. So, Michael, I would like to start with you because Euler has gone through a really impressive audit process with the launch of Euler v2. If I'm not mistaken, something like 12 different audit companies have created audits for the project. So can you mention like this is probably one of the most extensive and also expensive audit processes that we have seen. And given that experience, how do you think the industry should address security without really stifling innovation?
Yeah, I mean, it's we're working in a really nascent industry, right? It's barely 5 years old, and so we're still learning a lot about best practices and the best way to secure protocols. Over time, things have been improving, but it's always going to be an arms race. You're always going to have, as we make improvements, the bad guys make improvements in their models. We saw what looks like a very sophisticated attack on Radiant yesterday. So yeah, it is extremely challenging, and everybody has to put security top of mind for absolutely every part of the process from building the protocol. For Euler with V2, it all started right at the beginning of the process. We had people coming, right from the architectural design of the code. We had security-minded people come in to help advise and say whether they thought the initial designs were a good idea or not. That started way before most of the code was even written, really, just high-level proof of concepts. I think it's really important to write clear and simple code, keep things simple, modularize everything. A module is just a very simple piece of code that does one thing extremely well. That makes life much easier for auditors because they can focus on that one module and ask, does that module work well? You can then audit modules independently and in composition with one another, and that was one of the processes that we use with Euler. That's why it took so long, is we had all the modules independently audited right at their formation, and then later, once we built all the modules together into a more complex product, the complex product itself was audited in the context of all the modules. There's all sorts of different approaches you can take to secure protocols. It's not just about having audits and having guys come in and read the code and tick them off. All auditors have different styles and different preferences, so it's important to use a variety of different auditors. One of the emerging trends I think that's been really successful has been audit competitions. So we hosted one of the largest ever audit competitions on Cantina for 1.25 million bounty. And what's great about those competitions is, if you're hiring Open Zeppelin or one of these other leading firms, you're going to get some great engineers coming in, but everybody has gaps in their knowledge. Everyone makes mistakes. With an audit competition, you can recruit hundreds of different people from all different walks of life that come at things from very different backgrounds. And I think that can close a lot of the gaps that are potentially left by traditional audits. I think that's been a really successful model. Other things that are really crucial have been developments in fuzz testing and formal verification. Formal verification is this method where we can literally prove that a certain piece of code does exactly what it's intended to do. And fuzz testing, you can sort of blast protocols with randomness and push through and trying to explore edge cases that just weren't picked up by traditional audits. So there's lots of technology here that we can use, and I think we have to have, every team has to employ this Swiss cheese model where you literally do everything, every different step, and hope that any gaps that are potentially left being rocked by one process get picked up by another process. You just have to spend a lot of time and money on it, and that's how we'll build a better, brighter future, and that's how we'll innovate anyway. You can't rush these things.
Okay, thank you. Audit competitions are really getting more and more popular. I also know that there are a lot of Bulgarians participating in this audit competition. So it's really cool initiative. Grayson, I'd love to hear also your take on that. How can we find the balance between security and innovation?
Yeah, so definitely from developer side of you, definitely do your smart contract audits, do your decentralized insurance. But I also feel that because of all these kind of scam and exploits, actually kind of boosts us to think about security more and put user security as a focus. So let's say using Zerion as an example, when we build our new features, we always think about how do we make users feel safe. So for example, we've been investing in our transaction simulation. We're integrating with different anti-spam solutions, phishing alerts and things like that. Recently, we've been using blockade, I think, to just kind of flag users if they have made some sort of transaction that may be malicious. We try to always kind of make tokens in our verified list and then suggest what kind of tokens that users shouldn't trade or maybe should trade with caution. This kind of user experience, people really love our products because of that. And also we've been seeing a lot of industry trends about how people can do smart contracts or build blockchains in a more secure way. For example, maybe AI-assisted copilots that makes you detect loopholes in smart contract and things like that. So I think actually in some way, because all these kind of trends, it's making us build things in a more secure manner.
As a non-technical person, I have something to add here. I think the nature of the exploits that we've been seeing has changed a bit, right? DeFi summer is reentrancy or economic exploit, somebody listed a shit collateral and then you flash loan it and then take all the money out kind of thing. And more recently, it's been more compromising multi-sigs or compromising UIs of projects. So I think in that sense, we already have seen some progress. We're not making the same mistakes. We're making different mistakes, having 2 or only 3 people be able to do a transaction in a multi-sig or something. But yeah, I think like one thing to remember is like in DeFi, we're all building in public. Like if your bank gets hacked, like would you even know? Would they even know? Whereas like if you're in DeFi and you get hacked, like everybody knows. Yeah. You know what I mean? So I think over time we harden, we get better, and never forget that like everything that is happening in DeFi is like accessible to everybody. Whereas you know your financial app, on your phone, like you don't know what's happening there. They have to like tell you if they got hacked, right? Yeah, so that's something to remember.
I mean, you can never be too safe as a protocol. And we actually wrote a big piece of research on bridges. It's called the cross-chain risk framework, in which there is the most secure bridge. Risk is a spectrum, so it really depends on where you fall in this risk spectrum. You have some advantages, and I'm talking here about bridges, by doing it more centralized versus decentralized, but you're giving away immutability, for example. So it really depends on how fast you want it to be, how secure you want it to be, how much human math you want to put in behind the actual logic, or you just want to make it automated. It really depends, I guess. But at the end of the day, I think that for all of us builders in DeFi, security is the #1 priority.
Thank you all for the perspectives, especially something that you Amplice mentioned, that in DeFi everything is really visible. So when we have an exploit, if you're on Twitter, in like matter of 5-10 minutes after the start of the exploit, already there are probably tens or hundreds of tweets about this. So this is something that really changes the perspective of also the people, that they see that there are new and new exploits, but I also see that the space is maturing, the security is improving, so we definitely can be optimistic about this all. And yeah, let's try something fun to keep the energy up. Let's try a rapid fire round. So the rules are, I'll ask each of you a question, and you have basically have to respond with one word or one phrase, so keep it really short. Okay, sounds good? Let's try. If you had to choose one core DeFi value that DeFi should never compromise on, what would it be?
Disintermediation.
Composability.
Trustlessness.
Security.
All right, different answers. What's one myth or misconception about DeFi you'd like to debunk?
I think that it's lacking in transparency. That's what people would say in, like, outside the industry. They go, it's a bit shady or lacking in transparency.
I think this idea that like protocols are beholden to the users, like self-custody means self-responsibility. So you also, as users, you also have responsibility for taking care of your own funds.
I think for me it will be DeFi is antisocial.
That is not a Ponzi, guys. Trust us.
Okay, what's one piece of tech or infrastructure you wish existed for DeFi but doesn't yet?
The ability to not do all the crap with MetaMask and, like, you know, blind signing and, you know, just like use my fingerprint to make transactions.
Yeah, that'd be cool.
Something like, yeah, truly consumer facing, not in the way that like not with me as a DeFi power user consumer, but like my mom, something like that.
Yeah, I think like stronger narratives of the product you're trying to build, not just like incentives or like things like that.
Unified cross-chain messages. And the layer 0 folks, please don't come at me after this.
If you had to describe the future of DeFi once again with one word or a phrase, what would it be?
The future global financial system.
Up only.
Up only.
Inclusive.
Right?
What's the best piece of advice you'd give to someone entering the DeFi space for the first time? This could be cool for our audience.
Yeah, do a lot of research, spend a lot before you build, really get to know the basics well.
Don't succumb to nihilism. Like, what we're building is really fucking cool. Like, yeah, understand that.
It's like try losing some money and trade a situation.
I've seen so many success stories from people that didn't have anything to do with DeFi or crypto just because they were there. So be curious, always do your research, and always stay in DeFi. You will find success in some way, shape, or form.
Okay, lastly, I wanted to ask you from this rapid fire session, can you mention one DeFi project that it's, of course, not your project, but some other projects that you really like? And yeah, bonus points if it's not really one of the most popular ones.
Euler was one of my favorite first projects, the ability to, a protocol that essentially optimizes your yield for you. You never do that with a bank account, right? You're just stuck with a bank account. And it's like, even if you know you're getting a really crappy deal and they're treating you badly, you just never leave. And so imagine just having a really nice protocol that would just optimize and move you around into different places to optimize your experience. And that's what Euler, was back in 2020. That's what the promise was. And I thought it really attracted me to DeFi back then. So I've got to give a shout out to that.
Liquidity, I guess, because they've been around for a while and they have such a strong commitment to like decentralization and all these things that what DeFi is all about.
There's a GameFi project called Aave Gochi. I think it's like some GameFi project by Aave, and then just like mimicking your childhood games, and then it's pretty fun too. For first time like DeFi users to step into the world of DeFi.
I think what the folks from Jupiter are doing is great. They ship good product, they have product market fit, and whatever they ship, the users love it from day one.
Okay, thank you. These were overall really optimistic answers. So it makes me feel really bullish on DeFi, but it makes sense often here in the Bulgaria and around organizing the event. We are joking that we are all bullish and we are in Bulgaria, so it makes sense. And yeah, so lastly, I wanted to for us to go to the topic of the panel discussion. What do you think will lead to the DeFi Renaissance? I mean, would something lead to that? Are we waiting for something? And if yes, what would it be? I mean, should it be something like different market conditions? Are we waiting for some specific elections? Or is it something else? What do you think about this?
No, I don't think we're waiting for anything. I think the people in the room next door hacking away right now are like slow, steady progress building, like day by day. The only people that get sort of, if you speak to builders, everybody's always perma-bullish. Like when you speak to the developers, everyone's very excited about DeFi and not in any kind of panic. I think there's this obsession in crypto, partly driven by the Bitcoin cycle, the 4-year cycle of Bitcoin, where like we have to have a new narrative. Like there has to be a new narrative that takes us to the promised land, and we don't need that. We have already some great tech. It's constantly getting better. The UI, the UX is getting better all the time, and I think we just need to keep on building, and we'll get there.
I think one thing that might lead to quote-unquote DeFi Renaissance is if ever we get like regulatory clarity on being able to distribute dividends to token holders, then not only do some of these things become much more investable, you also have like an entire new product, like class of products that are like DeFi derivatives on top of like dividends, basically, right? So you can think like, oh, if you hold like Uniswap token and you're getting fees, okay, now you can have a pendle market on the dividend that you might receive from Uniswap. Like there's like a whole class of product out there that doesn't exist yet, and once this regulatory unlock happens, if it happens, I think we'll see a lot of cool stuff.
Yeah, I think for me as a builder, it would be nice to see like people kind of shifting towards like a tech-driven product building process to a more product-driven one. Which I mean is like, again, back to the point of having stronger narrative. So what you're trying to build is that, like, let's say account abstraction as an example. Like, we're not building products solely for account abstraction, but for the merits of it. Like, like a smart contract-based account, and then being able to do like automations, maybe like, for example, like setting limit for your trading amounts, and then without seed phrases. So I think these kind of like technical innovations allow us to have stronger narratives. But at the end, it's like, how do we make use of these things and build products people love? I think people really need to take a hard lesson on that, not just like doing incentives anymore, maybe like trying to optimize the yield, but it's like, how do we actually have more use cases for users?
We're past the parabolic move of adoption. I think it's in the 2 digits right now of how many people in the US hold crypto, not have heard of crypto, but actually hold crypto. So we won't see, a new renaissance, a new wave of adoption. I think that we're, like, to make a parallel with the tech bubble, we're right past the tech bubble, in which companies like Amazon or Google, they just stayed there, and it was a very slow grind for the next 20 years. And we're probably exactly at that point, in which for the next 20 years, it's going to be a very slow grind for DeFi, but it's going to be there, and legislation and regulation will adapt to that and will, push crypto forward.
Okay, thank you all for the interesting insights and your perspectives. I think that based on what was said on the panel, we can all be really optimistic about the DeFi future. So yeah, thank you for our amazing panelists. Big round of applause for them.